Hello everyone, it's me, the Boss Hog. We're back. I've got some important news, as you can see by the title, and that I sold a fair chunk of my position in Games Workshop. I'm going to explain why, talk through a ton of buys I've been doing this week, and give you an update on my position more generally. Let's do it. Okay, so in terms of interesting stuff to talk about this week, there isn't a ton of things here, just 3 bullet points. First of all, I have returned from holiday. I had a lovely time away, sort of 9 days. It was awesome. And yeah, I wish I could holiday all the time, which is, by the way, the long-term retirement plan. Unfortunately, literally just the day after my holiday, basically, I evidently caught COVID. It was officially confirmed as COVID when I was starting to recover. But basically, I got really nasty flu, like 40-degree temperature at 39.7 to be slightly less dramatic. But I was honestly really the most ill I've been for probably about 8-9 years when I last had flu, interestingly. And you can hear I'm still slightly recovering. So last week on Saturday and Sunday, I felt honestly dreadful. And then Monday and Tuesday, I actually had off work. I did like a couple of hours, but just to sort of do some reporting. But it was, again, official leave. I just could barely move out of bed. Had the whole like shivering while sweating nonsense as well. So that was horrible. And yeah, and I'm almost there, about 90+% better. My throat sounds a lot worse than I actually feel, but obviously it's still there. I got a slight headache as well. So that was part of the reason why I just didn't get around to doing a video last weekend as well. I had kind of hoped maybe I'll do it on Saturday and Sunday once everything was unpacked, but it didn't happen. And then once the work started and I needed to catch up, it was impossible basically. The only thing, therefore, I do want to talk about is the fact the FTSE 100 passed an all-time high. I think it's like, woo! Obviously, the FTSE 100, I say obviously, but if anyone doesn't know, the FTSE 100 outperformed every major index last year. It's just ultimately very defensive. So, when the world is bearish, it's a good place to put your money, I would say. In good times, it's probably going to underperform, and that's basically what we've been seeing, right, for at least a decade. But basically, it's exposure to a number of sectors that are defensive in nature. The fact it has a near 4% dividend yield also helps. Yeah, and it's got kind of the financials, the mining, the oil majors as well are all there as well. So it's obviously been a pretty good year for the FTSE 100. It's also benefited from currency exchange. A lot of its earnings are not in pounds. So when the pound is weak, when it gets converted back, then it's beneficial as well for the FTSE 100. So it's kind of had that FX impact. And yeah, basically as a result of that, I mean, it's really performing extremely well. So I think that's worth highlighting effectively. If you like these kind of milestones. So I'm going to stick with that. Excuse me. I'm going to stick with that in terms of this week, and then look to get back into sort of macroeconomics and political news next week. But without further ado, let's have a look at the portfolio and what I've been doing. All right, so a little bit unusual this week. We're actually going to start at the very bottom of my dashboard. Usually we don't go down this far, but because I didn't do a update last week, I think it's worth mentioning. So effectively here, the way that we can look at this is last week I got absolutely hammered, lost like 6,000. And then this week here we saw an increase of 1,000, as we're going to touch on in just a second. And similar in terms of my Google Docs as well. And for anyone who's new again, we make sure that Google Docs and Trading 212 are materially aligned, and as long as we are, then we are happy. So most of this week is going to talk about the week ending the 17th, but actually the week ending the 10th was a bit rough, and then since then it's kind of stabilized. So I just wanted to put that out there, just so you guys don't think I'm sort of glossing over a bad week for any reason. In terms of the detail then, so the delta between Trading 212 and Google Docs closed. Again, sometimes stuff seems to happen on Friday with Google Docs where it just doesn't update, so I tend to get better information from Trading 212. And then it will update the week afterwards, which is why it sort of closed the gap quite a lot and actually overtook it. So that's interesting. So yeah, in terms of portfolio value, we use this figure here, so 130,196, and that's taken direct from the brokerage. No new deposits this week. I am looking to add some more money next week. Yeah, we'll get to that very shortly. But between holiday and business trips, etc., just not a ton of money left over. We did have quite a big increase in our realised profit and loss. Most of that is around Games Workshop, which we'll get to in just a second. But there is one other sell in there as well that contributed. And then outside of that, our unrealised position broadly unchanged. And our dividends, likewise as well, effectively flat, but £10 across 3 dividends, and again we'll get that. So effectively, the way to look at this is, basically our profit for this week is
a sum of realised P&L, unrealised, and dividends gives us our 1016 there. So that's the way to think about it. Unfortunately, I've fallen back against the FTSE 350, so now it's beating me again. You can see there well, you can see by the graph, so that's unfortunate, but it is what it is. It's not too surprising because, as we touched on, the FTSE 100 is at all-time highs. Honestly, I feel like the FTSE 100 potentially even be higher. The market didn't really react very well to Barclays and then NatWest's trading updates, but actually I thought they were really good. NatWest in particular, but Barclays likewise was good, other than a pretty meaty fine. So I was kind of surprised that the market reacted so badly to both, and to be honest, I feel like if you had positive feelings about UK banks before, it's probably a good time to buy. I don't have any UK banks, unfortunately, but well, maybe fortunately, because again, the market just didn't like them, and you know, the financial sector is quite a large part of the FTSE 100. So even though the FTSE 100 broke records, it wasn't quite as much as I felt like it could be, but still enough to put it back above me, especially because there's been some falls in some of my larger positions. So yeah, a slight retreat in my portfolio value, but it is what it is, nothing too major. Unfortunately, just to highlight here that you know, a couple of weeks ago we had UK profit for the first time in over a year, as we've clawed back our big hit from Russian miners that are listed in the UK. But unfortunately, we've fallen back a little bit now, so we're quite deep in the red once more, but nowhere near as deep as we have been in the past in terms of my UK positioning. So this is where I think we're going to spend most of this video though. So I've now put our top 5, well, I've actually put the whole portfolio in order, just because I think it makes it a bit easier to read. We'll keep the top 5 color coded, although it is possible that over time things like Allianz Technology Trust and SMT might be in the top 5. So I'm going to keep the top 5 for individual positions, just because they potentially have most volatility and ability to influence. In terms of what's been dragging me down, it's definitely been primarily Amcor. Not too long ago, this was my largest position, closing in on an 18 grand stake. That's now down to a little bit under 16. So yeah, that's basically pulled it back quite a lot, to be honest. That has a very real impact. 10% here is, you know, over 1.5k. Part of this was because Amcor put out actually kind of okay results for Q4 and for the whole year, right? And to be honest with you, I think next week I'll do a deep dive into Amcor. I've been on the earnings call already. But essentially last year, you know, they made EPS of $3.11. So a share price of sort of 26.5 looks like a bargain, but their guidance, especially for H1 and indeed Q1 within that for next year, is just dreadful. And the market reacted very poorly to that guidance. Now, Amcor only guides a quarter in advance because of its what it does basically. So they refuse to give further, you know, real guidance beyond a quarter, but they are typically very close to their guidance. There was a slight miss, if you want to call it that, in Q4. So the number given, if you just look on Yahoo or something, would be 70 cents. But actually, their guideline was 60 to 80, and they actually had 67. So from my perspective, it was near enough the mid-range, if that. But because Yahoo picks a single number, it was counted as a miss. But I actually thought the Q4 numbers were reasonable. It's just the guidance was dreadful. But still, I have no doubts about Amcor. And to be honest, if you're, I would say it's nearing an opportunity to start buying again. Again, if you take a similar position to me. Genius had a good week actually. Part of that is in sympathy with DraftKings, which I thought put out a fantastic set of numbers, by the way. But there's also some hope that when it publishes results in a couple of weeks, that it will be similarly positive and basically show EBITDA profit for the first time for the financial year. So we will see how that looks. Now we get to the juicy stuff then. So Games Workshop, I sold 90 shares. So I still have sort of 73 shares remaining. And really I sold this for one main reason, which is that with coming changes to UK tax law, I didn't want to put myself in a position where I was being taxed for dividends. Most of my portfolio is in ISAs, which are tax-free. But you'll see here there's a big drop specifically for my Liam General account, which is outside of ISA. And that is dominated by Games Workshop. You know, previously that was like 16, 17,000. After the sale, it's now close to 9. But within that, Games Workshop still represents, you know, a vast majority of it, 7k as you can see. But what importantly means now is the size of my stake basically means that my expected dividend yield per year should be about £400 from my Games Workshop position, which will put me underneath the 1,000 and then the £500 that you get because of my earnings. Basically, I will qualify for the highest rate of dividend tax. I don't want to do that, so I decided to basically top up my ISA and do a transfer across. Unfortunately, that meant I had to sell out my Games Workshop, sorry. And at the moment, because my wife works in private equity and I can't buy individual shares, it basically meant I had to say goodbye to a fair chunk of Games Workshop, which is a bit of a shame. I did take a reasonably good realised profit here as part of that, about 14%, 13%, something along those lines, which is okay. And I still have, you can see here, even after the sell, it's comfortably my fourth position still. Before that, it was kind of vying up here for like a top three. They were very close together. So, and then Phoenix here continues to just chug along. I still think this is fairly materially undervalued, actually, with a big fat yield. So again, I'd probably be interested in buying more around this price. Maybe I'd want it slightly lower, but not. I think it's still a good buy. All right, so let's start talking about where I spent my 8 and a bit thousand, 8.3k. So first of all, I put 2k in Scottish Mortgage Investment Trust. Now, basically, this is my small and speculative tech ETF. The big and established tech goes into Alliance Technology Trust, but Scottish Mortgage Trust is a lot more speculative. Although, I mean, it does have big positions in things like ASML and other established companies that you will have heard of. But actually, like 30% of it, the ETF by value is in private listed companies, and so it's definitely along those lines. And it, basically their own thesis suggests that you need to hold them for at least 5 years. They have historically done a really great job outperforming the markets, but it's obviously been a very difficult year for them. I've been averaging down for some time, and now I'm actually really happy with my average at £8.12. So I mean, I'm still pretty red on it, as you can see. It's like £7.50, right? But this, I feel I've now got quite a chunky stake, and actually I've decided, like, I was reviewing SMT and a lot of their holdings. I think they have a really nice website. You can navigate their holdings, their top 30 holdings of 60. So you get like lots of detail about most of their positions, which for me is quite good because I'd never heard of a couple of their big ones. Like sort of Chinese e-commerce and things like that. So it was good for me to get a bit familiar with some of them. But actually, I really liked what I was seeing. They trade at a really chunky discount as well. Originally, I had thought that was because of their private holdings, but they do a really good job and get them independently valued as well in terms of that. So for me, it's trading at like a 15% discount to net assets, and it just looks like a good opportunity for me to keep on buying. Within that, also, some of their larger positions put out some good results last week. I thought, within that as well. So that was, for me, broadly speaking, positive. Outside of that, I sort of paused there at medical properties, and I think when I'm feeling a little bit better, I'll give a little bit of a summary, because that had a pretty good week off the back of Steward, their largest tenant, basically agreeing to sell their hospital to who will become a new customer for MPW. For me, it was really positive. The market reacted really well. It was difficult actually to find something that was not good about it. It answered a lot of questions about MPW's exposure to Steward. So going from 26% to 20% is a significant reduction. And they've also now got, I would say, a better quality tenant taking over this hospital. As part of this financials, it means also that Steward will be repaying a commercial loan early to MPW. So effectively, you're sort of addressing two bearish concerns here within one issue. The fact that they are overexposed to a riskier customer in Steward has been significantly reduced now. And by the way, that 26 to 20, even before that disposal, that had gone from 30 to 26. It was already falling back naturally anyway, as other parts of the business grew. But now that's a big reduction in terms of the risk. And they've got a new tenant, so that feels really good, and that new tenant looks great. And secondly, again, some people suggest it's wrong for a REIT to be so involved in commercial loans and joint ventures with their tenants. For me, I think for specialist REITs, it's more acceptable than it would be for a generalist REIT. So again, it's not a concern for me. But if you are a bear, it should be. It's gonna basically confront two of the arguments for it. I guess actually I have given a summary there. I couldn't let it lie. So I didn't make any movements on MPW. I'm still very much in the red. I have like a $15 buy price. But again, I'm optimistic. I'm definitely bullish on MPW. Other buys here, we've got iShares Clean Energy. Again, I'm actually more or less flat on this now. I seem to have bought my ETS at a relatively good time and averaged up quite significantly. Again, I just want exposure to green tech. I haven't done a huge deep dive into the ETF, but I know it's something that I want exposure to. So that's basically what I'm forced to go with. One of my dividends here for ASML, really like ASML. I'm almost ashamed I didn't have more of a position in it, but actually because I'm so green on it at the moment, I decided to use this to open up a new position, which we'll get to in just a second. Digital security, kind of similar to green energy, really. I know it's one of those areas that I want exposure to. I don't know the first thing about it. I've tried to get to buy digital security single stocks twice. It hasn't worked out for me at one time quite badly. Had to sell at a fairly major loss, and so I've decided just to trust the ETF on an area that I'm not particularly knowledgeable about. So here then, my next one is interesting. So a little bit of history here. So basically, this was in my wife's ISA beforehand, and what I decided to do was move this over to my ISA, which is increasingly looking extremely tech heavy. It's got all my semiconductors in, as well as a bunch, Scottish Mortgage. And so it's like when tech is doing well, there's not a ton of stuff for me to average down into. So I thought this would be a good thing to move over from my wife's ISA, which went into other positions. What it basically meant is I sold out, realised a profit here of 141, and sold out sort of but just over £1,000 stake. So I mean, I bought this almost perfectly and sold pretty good as well. Actually, honestly, I wish I'd done it for more money, as always with these things. And then I basically opened up a new position for 2k. In my personal ISA. So basically, I didn't transfer any money as part of this. I just basically sold it in my wife's ISA and bought other stuff. And then in my ISA from the Games Workshop sale, I've transferred that money in and then opened up a new position. So you can see here I'm slightly down, right? I bought in for £2,000 and it's currently worth 1970. But again, I feel really good about this. It's now my main mining play that's not a Russian miner sitting in deep red. And then my plan is here just to keep on buying and averaging into it. So automation and robotics, again, super similar for clean energy and digital security. I don't know a ton about the area at all. I think it's all cool and interesting. I have no idea who the winners are going to be, but I feel like it's important to get exposure to it for the future. So we, again, aggressively added into that. Then we've got the position that I basically hold my nose and buy into because I don't really like consumer discretionary. I've swung traded quite successfully Unilever in the past, but I think I'm quite negative on that company overall. And I don't really like consumer staples. I wish I'd bought into something like Costco. There's one or two really good holdings in this, but I think it's really expensive. I'm basically just forcing myself to get up to about 1.5% to 2% of my portfolio value, just as kind of a little bit of a hedge, I guess. But yeah, I don't really love the sector. It's difficult for me to get excited about it, and I just thought, I was basically fractionally red. This has been flat for me since I bought it, really. You can kind of see here on a kind of 3-month basis, which is how long I've been into it. So I'm just sort of averaging into it and accepting the fact that I'm going to have this position for balance. And we're going to go with it. It's basically going to be like my least liked position. So this one is new though, and this one is quite exciting. So this is where the majority of, in fact, this is where all of my sale went from my wife's ISA for the global mining. So actually a little bit more than I thought here, 1350. Excuse me, you can still tell I'm still recovering. And what I wanted here is I wanted exposure to companies that I'm really interested in. I've mentioned it once or twice on my channel before that I really like the kind of 1 to 5 billion, maybe more like 3 to 10 for American positions. I find companies in that kind of range interesting. I typically am employed by companies a lot in that range. I feel like I know what they should look like. And I find that they're kind of an interesting part of their journey where they're either going to scale to become monsters or basically lose it. And I find them all very interesting. Things like Games Workshop, like Fever Tree would group into there as well. Things like Amcor, they're only just bigger than that kind of range. Now the small cap 600 is kind of a bit more focused than the Russell 2000, but kind of similar. It's got a better long-term track history and it's more liquid, so I just slightly preferred it over the Russell 2000, but I think they're broadly comparable. And yeah, and with the small cap here, you're basically looking at a market share between about $750 million and $3.5 billion. So for me, again, that's quite an exciting part of the journey. And I'd actually like to spend a lot of time doing due diligence on at least some of the holdings in this 601 companies. But yeah, so I opened a brand new position within it. You can see here I'm very fractionally green, up about £7 so far. And yeah, really excited actually about this one. So I will be actively looking to add to this. It kind of ticks a box for me for the kind of good high growth, I hope, kind of smallish companies, but again, companies that are just about to become kind of medium and can build from that as well. So this is the exciting part to offset the dull part of W cost just above it. Very small dividend from Apple, and I also added this alongside ASML to open up a new position. I got a dividend finally from Dot Digital. This is like a mailing company, an emailing company. This was actually meant to be from the 31st of January. My broker was really slow. I had to actually chase them. And then magically it appeared later in the day. So I think they just forgot about me. And indeed everyone else who holds Dot Digital. I decided to average down here. I'm only down about 10%, but I just, I'm okay with it. It's quite a small position. So any average down has some impact. So here's where my dividend went for ASML and Apple. And it basically is a US focused bank ETF. So the way that the ETF works is it has the big four, as you'd expect, more or less with equal distribution. And then it has all of the regional banks within it. So when we look at my sector here, and it's just below, so I may as well scroll down, my financials is a bit lighter than I'd like effectively. So over on the right here, I've broken out the Canadian ETF, which I've grouped as financials because it's majority, well, it's the biggest chunk part of its financials, so it gets grouped there. But my pure financials is one bank, which is Huntington Bankshares, and then two UK insurers. That's basically all I've got really. And so I feel like I've had JP Morgan in the past, and now I have Huntington Bankshares as my kind of regional bet. But I wanted more exposure to financial services. I basically found this ETF, and the way that it works is it has the big four, so they call them national banks, and they're the ones that you'd expect, and that makes up 1/3 of the ETF basically within the top four. And then 2/3 of the ETF are across regionals. Now, I do have a little bit of overlap with Huntington Bankshares. I did consider whether I should sell Huntington Bankshares as part of this, but honestly, I still really like what they're doing, and I still feel like it's undervalued. You know, if this was like 17, then I might consider taking some money and putting it into maybe the S&P 600, the small cap. But for now, I kind of want to hold on to my HBAN, and also HBAN is only the 12th largest position in this bank's ETF, so it's not a huge overlap, basically. I feel like I get sufficient exposure, and it's my only overlap in the entire ETF. So this is something I'll be adding to probably relatively lightly to start with. I've essentially finished my ISA where this is contained. I'm going to put my Games Workshop dividend I'll be getting at the end of the month into it. But I don't expect huge growth immediately, but I'm just going to kind of look to add into it once the next tax year in the UK gets going, so from April. And yeah, new position for me. I'm quite excited about this one, honestly. I stumbled across it, but I was looking for financial exposure, and I'm happy that I now have it, so we'll see how this goes. To round off, I sold out my ETF position in video gaming and esports. I got into this without really doing sufficient due diligence, and when I did get around to doing due diligence, I hated what I saw. I was expecting a really interesting, risky, basically, esports ETF, and it had everything from slot machine makers to Japanese video games, not video games, like pinball machines and that was Pinko machines, and all kinds of weird things that to me weren't really esports. And I know it's like video gaming, so maybe I should have just thought more seriously what that meant, But again, I thought that meant like playing on the console and stuff, but actually they had different interpretations. So when I looked into it, I just realised it wasn't actually what I wanted at all. And I decided that more or less as soon as I turned green, I wanted to sell it. So I did manage to realise a very small position from this. I think actually I misspoke beforehand. So I think I was right originally that my global mining position was about 1100. And then I had a few hundred from here as well. Those two went together to open up my position in small cap 600. So I guess I was right the first time and wrong the second time. So recorrecting my correction. And yeah, so I'm really happy to be out of this one, basically. It isn't the ETF that I expected at all. And again, my thesis here was more or less, I don't know much about esports or game development or anything else. But what I wanted to see in it wasn't in it, basically. So yeah, although I think esports is going to be a high growth area for the future, this isn't the vehicle for me to be interested in it. But I would still, if anyone has a suggestion for an actual esports ETF, I'd love to hear it. So, but that's my position there. So I'll remove this line next week, and it will no longer appear anymore, and we'll go from there. My technology, I don't want to spend a ton of time on the segments, but actually it is just worth highlighting that my technology chunk now, especially once I break it out of the ETFs, is significantly large. I've decided here I'm going to limit myself to 50% of technology. I think anything over that is starting to get a little bit top heavy. Again, I'm 20 years away from retirement, so I think having long term higher volatility is absolutely fine and probably the direction I should be going into. But where I'm adding into things like Alliance Technology Trust and now Scottish Mortgage, like I group those as tech, and then things like digital security as well as also tech. So all of my buying at the moment basically has moved from consumer discretionary, or where previously I was nearing 20%, has basically been transferred, and a lot of that's gone into technology. So I'm going to limit myself to 50% of technology. Again, if Amcor was to recover as well, that would have a material impact over here as well. So it's not impossible that this isn't a million miles away from turning into 50%, and start kind of looking at other positions that I can buy into a bit more. But yeah, that's the reason there. So actually quite significant change. So a big reduction in consumer discretionary. This one here that isn't quite coming through, I think my data label's off, but this is my non-discretionary, so everything in the ETF there. Once you break it down. So again, that's why non-discretionary doesn't have its own sector over here, because I don't have any sort of Unilever or anything, and then it's all grouped over here. So that's interesting. So my February is actually due to be a pretty good month, but my two big dividends come at the end of the month in Games Workshop and Hollywood Bowl. So both of them are being paid on the 24th, so a couple of weeks away for them, unfortunately. But yeah, I did get those free dividends from Dot Digital, Apple, and ASML, so that feels really positive. And again, here we're expecting our Q1 to be relatively modest, but because of my those two positions, but mainly that Hollywood Bowl has now gone through the recovery and is reopening, and now it's starting to make good money again. It's reinstigated its final year dividend, and it's a pretty good one. So that's going to be the main sort of difference. And as well, actually, Games Workshop is throwing off serious money as well. So again, a good dividend from them expected on the end of the month is really going to help boost Q1 compared to last year. So that should be really good. Anyway, as you can probably tell, my voice is starting to give out, so I think that's going to be everything from me. A bit of a long walkthrough, especially of this bit, but again, just a significant amount of buys following my sale. Next week, I'll look to bring an update from, I think I'll look to do the Banks ETF. I think, honestly, it's a cool one, as well as the Amcor as well. So, I feel like I should be talking about my second largest position, and I think it's a share that no one really covers. And again, I think there's some interesting stuff happening within the semiconductor industry, as well as Amcor. And honestly, I think it is a buy if you wanted a semi exposure. Obviously, I'm happy with my very large position, but that's how I'm feeling at the moment. So really confident as well. In a couple of weeks, we've got Genius and their results, so that's also going to be a big one as well. So time will tell. Anyway, I'm going to stop talking now. Thank you very much for watching, everyone. I've been the Boss Hog, and good luck with your investing. Bye for now.